Well, hello everyone, and welcome to today's webinar, Emerging Economies in 2019, Heading from the Next Downturn. My name is Esmeralda del Olmo, Marketing Manager at ISI Emerging Markets. And today, I'm with my colleague Alexander Ivanov, Chief Editor of our Foresight Report, which will be presenting the webinar. Thank you all for joining us today. Before starting, I would like to give you a short introduction. For the ones who are not familiar about ISI Emerging Markets, our group incorporates CEIC and Economies, two of the leading providers of data, analysis, and research. Today, Alexander will present our views on key developments in the global economy in 2019 and what effect will they have on major economies like China, Brazil, India, or Poland. Before I hand the control to Alexander, I would like to mention a couple of points. First of all, you have the opportunity to ask any questions. You can submit your questions using the panel on your right. At the end of the webinar, we will answer them. And second, we also have a handout section with the presentation of today, but also with our Foresight report. So both of these documents are attached. With that said, I pass it to Alexander Ivanov.
Thank you, Esme, and thanks everyone for joining this webinar. So I hope you all see my screen. So over the past 6 months, the expectations for the global economy in 2019 have been substantially revised downturn amid the slower growth of the US economy in the second half of 2018 and the disappointing results of some of the major economies, notably in Europe and in Asia. So the global economy growth expectations were revised down by 0.1 to 0.2 percentage points to an annual growth of around 3% for the whole global economy by the World Bank in January and by Focus Economics consensus forecast in March 2019, while the International Monetary Fund remained more optimistic over the global growth in its January forecast, predicting 3.5% growth for the global economy in 2019 from 3.7 predicted in the October IMF World Economic Outlook. So the downward revisions have been made by most of the well-known forecasting institutions in both private and public sectors, mainly because of the expected negative impact of the trade tensions between the US and China, and also the negative growth prospects for the Eurozone over that period due to the weaker than expected performance of the Eurozone's main growth driver, Germany, and the concerns over the sovereign and financial risks in Italy. Moreover, there have been growing risks related to possible no-deal Brexit and greater than anticipated slowdown of the Chinese economy amid the impact of the US tariffs imposed in 2018. In advanced economies, the growth of the United States is expected to remain solid in 2019, outpacing that of the other developed countries, while the growth in Japan and the Euro area will remain lower, indicating a possible business cycle divergence between the United States and the other advanced economies. In emerging economies, the 2019 growth was revised by the IMF from 4.7% in October 2018 to 4.8% in January 2019 update. So as in 2018, and as well as in the previous year, the emerging Asia will be the main growth driver for the growth in the emerging markets as a group, expected to increase by 6.3% in 2019 from 6.5 growth in both 2017 and 2018. With China growth is expected to slow down to around 6.2% in 2019 from a growth of 6.6% in 2018 due to the trade tensions with the United States and due to the continuous structural transformation in the Chinese economy, while India is getting back on the growth track after the deterioration related to successfully implemented large-scale reforms in the country, including the demonetization and the development of the goods and services tax system. While in ASEAN 5, the growth is expected to remain relatively stable at around 5.1%, driven by the strong private demand, which is expected to offset the slowdown in exports due to the lower external demand. In Latin America, the growth for 2019 was revised by the IMF from 2.2% in October 2018 to 2% in January 2019, with the Brazilian economy continuing to its recovery from the recession in 2015, 2016, and the growth in Mexico, Peru, and Chile remaining strong, driven by the private demand and accommodative fiscal and monetary policies. On the other hand, the contraction in Argentina has deepened after the Latin American economy got $57 billion bailout in September 2018, which was the biggest one in the entire history of the IMF. And of course, another drawback for the growth in the region is the collapse of the economy of Venezuela. In emerging Europe, the largest revisions for 2019 growth was made for this region, mainly due to the expected contraction of the Turkish economy and weaker than expected growth in Russia. While in Central and Eastern Europe, these economies are also losing momentum due to structural challenges that have to be addressed in the long term after a decade of very strong growth in the economies of Poland, Hungary, and Czech Republic. Also, the growth of the Eurozone countries is expected to have a negative impact on the economies from the Central and Eastern Europe due to the tight trade and financial relations of these countries with the core Eurozone countries. So, in order to predict and understand what's happening in the emerging economies, it should be noted that the distinction between the short term, the medium term, and the long term is more important now than before. So first we have the short-term effects of some major events that have an impact on the emerging economy's performance. And there is no doubt that the most substantial one in the past 2 years has been the trade dispute with between the United States and China, and the tariff imposed on major goods by both countries to each other. The outcome of Brexit and the continuous sanction for various countries will also have an impact on the emerging economy's performance. And while the trade wars with the United States has more impact on Asia, not just China, but other Asian economies, and to a certain extent on the Latin American economies, Brexit and sanctions that the one for Russia have negative effect mostly on the European economies. Then we have the factors related to the business cycle and the cycle position of both the advanced and the developing economies. One business cycle related factor that directly reflects the emerging economies is the monetary policy of the Fed and the central banks of other major economies. And finally, the long-term factors that are shaping the development of the emerging economies are those related to the long-term economy growth and the catching up of the emerging economies with the advanced economies. One factor that can have both substantial short-term and long-term effects to the emerging economy as a group is the performance of the Chinese economy and the magnitude of its moderation. So yes, if there is one thing that is certain for the year 2019, is that the Chinese economy will slow down. The growth in 2019 is expected to be around 6.2%, and it could be revised with a few percentage points up or down later. But the magnitude of the slowdown will be determined by the short-term headwinds that the Chinese economy is facing, including the trade dispute with the United States and the effects of new tariff rates increases, and the continuous process of the debt deleveraging and its effects to the Chinese companies. In the long term, the Chinese economy will continue to slow down due to structural reasons such as maturity of the economy and transformation from fast growth driven by exports and foreign direct investments toward slower but more sustainable growth driven by domestic demand. But for sure, there will be a slowdown, further slowdown in Chinese economies in 2019. But a slowdown doesn't mean collapse. Over the past few years, this collapse of the Chinese economy has been widely expected, mainly by foreign observers. China was expected to implode a few years ago in 2015 when the Chinese capital market had a correction in August 2015. China was considered a ticking financial bomb because of its high debt, especially after this downturn. But all of these predictions appear to be wrong, and this can be explained with the specific nature of the Chinese economy. So first of all, the Chinese government has more room to react on such headwinds than any other major economic government. The corporate debt of China is high indeed, but the public debt is still relatively low compared to other major economies. Moreover, it's mostly domestic debt denominated in China's old currency. So the central bank of China can easily monetize it. So the government still has quite ability to borrow more. So that China can continue to react on the slowdown related to the supply side transformation with demand side measures. Also, let's not forget the long-run positive effects of the supply side reforms in China, including first the debt deleveraging, with after this process is complete, the companies will have more resources to invest than they have now, given the still high corporate debt in China. Second is the reform of the state-owned enterprises in China. China's economy being still in a transition period, needs more competition, and by reforming the state-owned enterprises, the China government is actually increasing the competition in the country. First, by shifting the state-owned enterprises from public to the private sector, a process that happened in Western Europe in 1980s and in Eastern Europe in 1990s. And second, it increasing the competition between state-owned enterprises and increasing and opening the China economy for foreign companies, which is increasing the competition more by having these foreign players on the Chinese market. So all of these results in all of these developments and reforms will result in an increased productivity growth that will have long-term positive effect on the Chinese economy. So another factor is the cycle position of the advanced economies, which also to a certain extent determine the cycle position of the emerging markets, because usually the emerging markets cycle is following the cycle of the developed economies. So over the past few years, there have been growing divergence between the cycle position of the United States and that of the rest advanced economies. And this can be seen in the GDP growth expectations and the and the estimations for the output gap. So as you can see, the currently and the output gap expected for 2019 of the euro area is positive as well, while for the UK it's closed, and for Japan is also near zero. For euro area it's positive, but for the United States it's much higher, related to the potential output of the economy. And here are two more indicators that show the cycle divergence of these countries, and both of them are available in CEIC database. So on the first chart are presented the growth projections of the individual panelists included in the Focus Economics consensus forecast. As you can see on the scatter plot, out of 52 panelists for the US forecast, the red dots. So out of 52 panelists of them, 24 revised their predictions for the US economy downward in March 2019 compared to October 2018, and 28 have either improved or kept their forecast unchanged. Overall, the distribution, is a zero mean. So any deviations from the zero may come from different models they use, the different variables included in their models, but the reasons are not fundamental reasons that lead to revisions in forecast. While for the rest two countries presented on the chart, Japan and the euro area, there have been only a few panelists who revised their predictions for Japan upward, while the majority has revised it downwards. And for the euro area, all panelists in the survey have revised their forecast downward. On the other chart is the CEIC leading indicator, which is a new addition to our database. This is a composite leading indicator that anticipating the business cycle and the turning points of the business cycle with relatively 6 to 9 months ahead. So the indicator suggests that the US economy may have reached a peak at least a quarter later than Japan and the euro area. As you can see, the indicator for the United States peaked in February 2018, while the indicator for Japan peaked in December 2017, and the euro area peaked in October 2017. Moreover, after the peak of Japan and euro area, as you can see on the chart, the indicator reversed to a substantial downturn, while those for the US economy remained relatively flat until it also went down after August 2018. So discussing the cycle divergence, currently the US is enjoying one of the longest expansion phases in the history of its business cycle, which is mainly prolonged by the President Trump administration massive fiscal stimulus. However, it's doubtful whether this trend can persist without that stimulus. The business confidence that is currently encouraging private investment derives mainly from temporary factors such as the corporate tax cut and the wealth effect of the unprecedented stock market rally in the past 2 years. Now, one might assume that if the growth phase of a business cycle has lasted for more than a decade, the combination of a pro-cyclical fiscal policy and still relaxed monetary policy would overheat the economy. But can we say that this is in fact what's happening in the United States today? So first, the US GDP growth is estimated at 2.9 in 2018 and is projected by the IMF to reach around 2.5 5% in 2019. That's much better than the other advanced economies, but it's not much more than the average growth rate of the United States in the pre-crisis years, when the average growth from 2002 to 2007 was 2.8%. And it's way below the long-term average in the growth of the US economy. Then there is the capacity utilization that was, as you can see, the levels in 2018 are far below the levels of the peak years of the previous 4 expansionary cycles. What about the inflation? Well, over the past year, there has been rising concerns over the that inflationary overheating could prompt a rapid monetary policy tightening by the Fed. However, these worries reflect an increase only in the headline inflation, which is to a large extent driven by the high energy prices. While core inflation, the measure that excludes energy and food product prices, has barely reached the 2% target. So one may ask what the inflation level would be without the stimulus. Moreover, if you see the data for core personal consumption expenditure inflation, which is the inflation indicator that the Federal Reserve is using when taking monetary policy decision, you can see that the core inflation measured by this indicator is even lower, and it's far below the 2% target. There are various leading indicators that are signaling that in business cycle terms, the US economy may have reached a peak in the second half of 2018, and that this could be a turning point for the global economy as well. So the Market Purchasing Managers Index peaked in Q1 2018 and has been trending downwards since then. And the volume of new construction started in the US peaked in May 2018, and the retail sales growth flattened in Q2 and Q3 of that year. So indeed, these indicators are trade sensitive, so they may be affected by the trade dispute with China. But the yield curve also suggests that the US economy may have hit a peak in the second half of 2018. So even if it's hard or even impossible to anticipate when the expansion period of the US economy is going to end, and what's certain is that the US looks less prepared than ever for the next downturn. And this statement is even more valid for the other developed economies like the Euro area and Japan. So the history of monetary policy easing in the last 9 US recessions shows that it has required an average drop of 5.1 percentage points in the real funds rate for the economy to rebound. Now, the real funds rate is already negative. And moreover, except for a couple of months, it has been negative throughout the past decade. So a question arises, can the Federal Reserve afford to decrease this rate by the required amount and leave it too low for too long, as long as it takes for the economy to recover? And what would be the price paid for such a long period of low or even negative real interest rates, given investors' tendency to seek higher yield on riskier assets when risk-free premia are low? So all of this suggests that when the next downturn hits the US, policymaker will have to face a dilemma between maintaining sound growth and keeping financial stability, given the long period of too low interest rates. So what does this mean for the emerging economies? If if a downturn, if the U.S. a downturn happens in the U.S. economy, the spillover effect across, there will be a spillover effect across the emerging economies. And what's certain is that there will be an immediate effect on the export-oriented emerging economies, because the U.S. is still a major market for their exports. But on the other hand, the Federal Reserve will give up any idea of further monetary policy tightening, and maybe keep the interest rate at least on the level that are now, so that it continues to stimulate the economy. The low interest rates in the U.S. and the other advanced economies will result in a rise in capital inflows back to emerging economies. In the years after the global financial crisis ended, the record low interest rates in the U.S. and the Fed's quantitative easing program triggered unprecedented capital inflows to the emerging markets. Net capital inflows totaled more than $900 billion during the years from 2009 to 2014, before turning negative in 2015, when policy tightening started. In 2012, when capital inflows peaked, they amounted to more than $200 billion, which was 60 billion more than in the entire decade before the global financial crisis. But the emerging economies have changed since then. Today, the population in the major emerging economies is aging, and the labor force growth is slowing down. Moreover, most of the major emerging economies are in a transition to changing their growth model from driven by exports and foreign direct investments to domestic demand, which gives a central role of the domestic consumption. This means lower private investment, and given the debt deleveraging process that is undergoing not just in China but in other major emerging economies, all of this means that we could expect a lower demand for loanable funds in the emerging economies over the medium to long run. And all of this suggests that the emerging economies may have lack of investment opportunities to absorb the additional capital attracted, which will threaten their financial stability and growth prospects in that countries. So what's certain is that long-term growth and catching up with advanced economies can be achieved without a substantial capital accumulation and the necessary investment outlets. So this was defined by the American economist Alan Hansen in 1930s. So he basically defined these investment outlets, including inventions, which is more or less the technological progress, new territory and new resources, and the growth populations. So we're not discovering new territories for a while, so we can focus on the rest two factors. Over the past 3 decades, the demographic factor was a key driver for the emerging economies over the past 2 to 3 decades, while growth in Europe's emerging economies has been driven mainly by the positive effects of the market-oriented reforms started in the early 90s. The fast development of the Asian and the Latin American economies has, to a large extent, been due to the favorable demographics enjoyed by these countries. So since 1970s, the percentage of working age population of Asia and Latin America has increased dramatically, establishing a solid base for growth and convergence with the advanced economy. Moreover, the declining fertility rate and the decreasing number of dependents has boosted households' capital accumulation, which has helped emerging economies to develop a sustainable entrepreneurship environment and to improve their education system, which are both crucial factors for the long-term growth and catching up with the developed world. However, the natural growth driven by the demographic conditions cannot last forever. So persisting low fertility rates eventually result in a decline in labor force. As large age cohorts reach retirement age at the same time, the demographic structure of the major emerging economies today suggests that they are gradually approaching the end of this era of favorable demographic factors. The investment rates measured by gross capital formation, the investment rates in the major emerging economies have already been declining since their peak in 2010, 2011, in terms of, as you can see on the chart, in terms of both percentage of GDP and annual growth, suggesting that the growth in the emerging economies may require new investment outlets. At the beginning of the convergence process, emerging economies were catching up at a pace similar to that of the fastest growing economies of the post-war period. Well, here we may discuss about all of these indicators, whether we should use GDP per capita measured in US dollar terms, or we should use purchasing power parity. Also, when this conversion process is actually starting. I choose a starting point when the emerging economies exceeds the 30% of the US GDP per capita. So whatever indicators or methodology we use will come up with similar results. So lately, however, the conversion process has slowed down significantly, and these demographic trends would appear to be, which are the main factors for this reverse in the conversion process. So these demographic trends would appear to be reversible. So sustainable growth in the emerging economies will, in the long run, depend increasingly on their ability to increase both productivity and labor participation rates, given the lack of this favorable demographic environment. So all of this suggests that in order to get back on the fast growth path, the emerging economies may have to reconsider their economic policy and find the right solutions to continue to grow in a sustainable way. So the solution can be on the demand side, where the lack of private investment can be offset by increasing fiscal spending. But here it's important to make the difference between the effect of capital and current expenditure, and thus not repeating the story of some of the Southern European countries that end up with high debt pressure. If the main growth driver for the emerging economies, the growing working age population, is no longer available, the sustainable growth requires new investment outlets and new investment opportunities. So when the development and the emerging markets have reached a maturity point and the growth has slowed down, investing in frontier markets look a possible outlet for investment. So countries in South Asia or Africa and other regions has been benefiting from strong GDP growth, favorable labor market conditions, and still low labor costs, and underdeveloped infrastructure that requires substantial investment. But of course, these countries need to improve the business environment and the institutional framework in order to become safe places for investment. And the technological changes is probably the most important investment outlet for the sustainable long-term growth of the emerging economies and the increase in productivity. And there are many positive developments here, given the amount of resources and investment that countries like China and India are investing in developing new technologies. Moreover, countries like Brazil, India, China, Indonesia, and even Nigeria are among the leaders in the Internet of Things, just like Brazil, Poland, and Turkey in the nanotechnology segments. So all of this is a reason for optimism that the emerging economies will benefit from the phenomena called leapfrogging and skip the era of older technologies and business practices, taking advantage of knowledge that is publicly available in developed markets and directly incorporated new generation technologies. Thank you very much. So Esme, back to you, and we can open the floor for questions.
Thanks, Alexander. It was a really interesting and insightful analysis of emerging markets, emerging economies for 2019. We have some questions from the audience, but if someone have any other questions, please feel free to use the panel on your right to ask any questions. I think, Alex, you can see them as well. So if you want to start, we have one which is, yeah, okay, sure. Then you can start.
Okay, I can read the question and then answer it. Okay, so first question, do you expect the interest rates to remain low for more years ahead? That's an interesting question. I guess so. So there are various factors that determine the levels of real interest rates. I'll answer the question in terms of real interest rate because the other is affected by inflation. So one is a temporary factor, and it's related to monetary policy shocks. And it seems that given the current environment, I think the monetary policy now has a limited impact on the real interest rate. So I'll focus more on the other factors that are more structural and related to the natural interest rates. This includes global supply of loanable funds or saving. Global on the demand side includes the demand for loanable funds or investments, and also the investor preference toward safe assets against risky assets. So when we have, as we currently have, increasing global saving, something that has been widely discussed by the former Fed chairman Ben Bernanke. When we have decreasing global demand for loanable funds, and when we have in relative terms, when we have an increase in safe assets against risky assets, there will be a downward pressure there will be a decline in natural interest rates, and there will be a downward pressure on the real interest rates. And I don't see any signs that these trends will reverse in the near future. So my expectation is, you never know what's going to happen, but my expectation is the real interest rate to remain low for quite some more time. Okay. We have a question on Colombia. What's the projection for Colombia? And will credit rating for Colombia will be reduced in 2019 or 2020? I'm not sure about the credit rating because you never know what the credit agency will do. But there are some positive developments in Colombia that I'm sure will affect the economic performance. of this country and affect the credit rating of the country in a positive way. And one example is the investment program in infrastructure. It's called the 4G program. So another good performance for the economy. So I expect the credit rating at least to be improved in the next year. Okay. Do I see? It's from the same person. Do you see any change to international monetary system in the long run? This, in certain extent, relates to the first question on the real interest rates. So, given the new environment of real interest rates, and given the increasing financial risks that results from this period of negative or low interest rates, I'm sure at least the financial requirements and all the policies related to risk management will become more tightened, because the financial risk is increasing due to the low interest rates. So this is what of course there are other developments, for example, related to the increase in supply of US debt, because even though there are some discussions over still over austerity measures, mostly in Europe, and debt freezing in the United States, I believe that the debt of the United States will continue to increase, and this will be another factor that will be shaping the international monetary system in the near future. I think it will increase first because of what I discussed in my presentation, because of the limited power of the monetary policy on the one hand, which may leave the fiscal stimulus to be the only game in town if a recession comes, or even a downturn. And on the other hand, I think the United States and other advanced economies, given the current environment when the nominal interest rates are lower than the nominal GDP, I think in this environment, the advanced economy shouldn't be, the US and the rest of the advanced economy shouldn't be too afraid of increasing their debt. So I think that they could relax on that term. What will be the place of African emerging economies in the global economy? As I said at the end of my presentation, African economies, just like similar economies in South Asia or any other regions, African economies may be, if they create a good opportunity and good business environment, they can attract a lot of investment for both the advanced economies and the emerging economies, given the market saturations in the major emerging economies and the advanced economies. I think African economies will be a good opportunity for investment outlet, but some improvements in the institutional framework is needed there. But I'm sure that the place of the African economies will be growing as part of the global economy and their importance. And this is visible from the involvement of the African economies in large-scale projects, like, for example, the Chinese Belt and Road Initiative. Okay, Esma, do you have time for more questions?
I think the time is over. We have a couple more questions, but we will answer them by email. So okay. I just want to say thank you everyone for your time today. We hope you enjoy it. We will send shortly a short survey to hear your feedback about today and also the recording of the webinar. And of course, if you are interested in other key topics on emerging markets, please, we really recommend it to download our foresight report and read our in-house analysis. Many thanks once again, and I hope to hear from you soon.